Welcome back to another top dividend stocks video. So yesterday I released a top dividend stocks video, and today I'm going to be giving you 5 more dividend stocks that I believe are great, and these are also great stocks to supplement the last list. And holding all of these together, I believe you can have a generally low risk portfolio bringing you great dividends. So if you like videos about personal finance, stocks, stock picks, etc., please hit that subscribe button down below for more videos like this. If you like the video, hit the like button. If you don't like the video, dislike, and leave down in the comments below what I can do to improve my videos or get your subscribed. So let's get right into this. So first off, we have Verizon Communications Inc. Now, if you don't know what this is a telecommunications company, kind of like AT&T. Now, they have a more conservative dividend yield at 4.33%, but this also comes with an upside of having a low payout ratio at around about 40%. The dividend frequency is quarterly, so you're going to be seeing 4 payments over 1 year. The stock performance is up by 21.5%, and that's even including the pandemic. That's over the past 5 years. Now, this is amazing because if you didn't know, in March we had a big crash and most stocks are down even over the 5-year period. So moving on, revenue, cash flow, and EPS. The revenue is up by 0.7%, cash flow is up by about 5%, EPS is up by 14% over the past 5 years. So as we can see, the company is growing and expanding, and they're not losing money. So that's always good to see. That means that they're going to be able to hold up this dividend paired with the low payout ratio. So also a beautiful thing to see is that the dividend has been increasing over the past 15 years consecutively. So this basically means that 4.33%, you're going to be seeing that raise every year. Also, the bonus is there's compound growth, and it's a very strong company, and the stock has just been going up like crazy, and it has not slowed down. So you're going to see some good growth and some good dividends coming in from this company. Next, we have Orange SA. Now, if you don't know what this is another telecommunications company in France. Now, as you can see, their stock price is on the cheaper side at about $12.38. This is not much of a growth stock. This is mostly a dividend stock because you're not going to be seeing this company grow. It's kind of like AT&T. It's a fairly stagnant stock price. It's not really going to be growing or losing money. It's going to have lots of volatility, but it's going to stay in that about $12 range. So the payout ratio is low again. It's almost 70%. The dividend yield is about 8%, which is amazing for this payout ratio. Not many stocks are able to actually bring forth an 8% dividend yield while keeping that payout ratio under 100%. The dividend frequency, however, is semi-annual. Now, this means you're going to be getting 2 payments over the year. So, I don't know, that's not really my preference, but I don't think you can really argue that considering you are getting an 8% return on your money, which is just amazing. So, the stock performance is, however, down by about almost 30% in the past 5 years, but as you can see on the graph, that's mainly due to the March crash. So I do believe the stock can maybe go back to where it was. If not, it's probably just going to bounce around that $12 mark right now, and I don't really think we're going to see growth or loss in this company. So I just love this for a dividend stock with a high dividend yield and a safe company. Also, the revenue, cash flow, and EPS have been going up solidly. The revenue is up by 1.4%, cash flow is up by 8.7%, EPS is up by 20.5%. So dividend increase, 2 years of consecutive dividend growth, not too amazing. It just means that they just have some years where they're cutting it and some years where they're growing it. Next, we have BTI on the New York Stock Exchange, or British American Tobacco. Now, people love tobacco stocks for dividend stocks as they do provide very, very high dividend yields. Yet for the tobacco stocks such as PM or MO or UVV, or PM is Philip Morris, MO is Altria Group, and UV is Universal Group. So the reason I don't like those is because their revenue is down, their cash flow is going down, and so is their EPS going down. So the companies are actually losing money. So that's why I don't really like them as an investment for dividend stocks. And also, the stock has been going down, and it's not really a good investment compared to how much you're going to be getting return on your dividend. So that's why I chose BTI, British American Tobacco, because this is one of the rare tobacco companies that has had its revenue up, which is up by 13%. The cash flow is up by 11.5% almost. The EPS is up by 8.2% over the past 5 years, which is amazing for a company in general, and especially for a tobacco company. So stock performance is down by 41.8% the past 5 years, but it's not really something to worry about because it did have a massive crash in 2018 and stayed pretty stagnant around there, and I don't really think it's going to crash down too much more because it is showing great growth, and overall it's a great company. And honestly, for it to crash, I think there'd have to be some really, really bad news coming out. And going back up to the payout ratio is about 80%, so that's good. They're not going negative. And as you get in a lot of these other tobacco companies, you're going to see quite a high payout ratio. But honestly, yeah, this is pretty much my favorite tobacco ratio. And although some people may consider these unethical, you got to get that money somehow. So dividend increase 2 consecutive years of dividend growth, not too impressive. But moving on, we have Visa Inc. So the reason I included this one is because when you're building a portfolio, you want to have some risk management. So I included this one because we see amazing growth, so that's going to be able to bring in some money, not necessarily in the form of dividends because the dividend yield is quite low at 0.61%, but still going to bring in some money. The payout ratio is amazingly low at 20%, which is expected when you have such a low dividend yield. Now, dividend frequency is quarterly. The revenue cash flow has been beautiful. The revenue is up by 12.6%, the cash flow is up by 16.7%, and the EPS is up by almost 20% over the past 5 years. And here's what's beautiful: dividend has been increasing for 11 years consecutively. So as I said, the reason I included this is not necessarily for its dividend yield, but for how little risk is associated with this. This is going to be able to bring the overall risk in your portfolio down by so much, because although most of these are fairly safe, they do still have some sort of risk, since we are seeing some payout ratios in the 80 to 90, which is in the higher range. So including a stock like this with a payout ratio of 20% is really going to bring that risk down. So that's why I included, and that's why I am including this stock in my own portfolio for dividend investment, because it's just an overall great stock for growth, and you're still going to get that little bonus of dividends, and it's going to bring down your overall risk. So next we have EPD, or Enterprise Products Partner LP. This is an energy stock, so be careful with these because the price is very either stagnant, or you're going to see massive fluctuations where there's going to be a massive gain or a massive loss, such as ExxonMobil. We saw that their payout ratio, for example, has extreme fluctuations. When oil loses lots of money or lots of worth, you're going to see that payout ratio skyrocket to maybe 134% or something around that. And then when the oil prices rise, you're going to see that payout ratio go down to maybe 40%. So this is something that you have to watch out for with energy companies, is that energy is not necessarily a set product price, such as these other companies or like BTI or Verizon. They have set plans or set prices on their products so that they're going to be able to bring in that solid revenue. Compared to energy, they have a market where the prices can fluctuate, and you might see that fluctuation. So however, I include this one because the past 5 years, as you can see, has been beautiful. It's been stagnant. We haven't seen growth or loss, and that's beautiful when dividend stock comes in, because you're going to have less risk, and you're not really going to see people trading it too much, in the sense that there's not really going to be massive fluctuations. It's going to hover around that price range that it was at pre-COVID levels. So dividend yield is 9.75, which is astoundingly beautiful for the payout ratio of about 83%, and dividend frequency is quarterly. Stock performance is down by 35%, but as you can see, that's mainly due to the March crash. Overall, the 5 years without the March crash, it would have been at around like breaking even or about a 1% gain. The revenue is down by 7.3%, cash flow is up by 9.6%, EPS is up by 7.1% over the past 5 years. So overall, the company is growing and they do have money coming in. However, the revenue is down. So as I said, this is the thing with energy. Sometimes the actual demand for it goes down or up, so it's not really necessarily a growth stock. But dividend has been increasing consecutively for 20 years, which is amazing. So we might see it maybe reaching 10% one day. But yeah, I hope you guys enjoyed this video. If not, leave a dislike. If you liked the video, hit the like button and subscribe down below for more videos like this. I upload these every other day usually, unless there's unforeseen circumstances, and if not, I do upload at least a minimum of 3 times a week. So thanks for watching, guys. Look out for the next video. It's going to be a video about how to invest $500 in the stock market for a safe investment that's going to be bringing you a guaranteed around 6% return over the years. And then I'm probably going to do a $1,000 portfolio one also. But yeah, that's it. Thanks for watching, guys.